that's the first part of tonight's lecture. The second part is the idea of leverage, calculating the degree of leverage. What is leverage? Well, it's related to our cost structure. And our topic for the last 3 sessions, or this session and the first 2, are all about understanding cost behavior, fixed and variable costs. So we're going to go through a bit of review again and the very basic CVP concepts. Then we get into sales mix, okay? Again, cost, volume, profit analysis is a study of the effects of changes in costs as volume changes and the effect those changes have on the company's profit. Of course, this is a very important planning tool for management. Management quite often is predicting, what if I change the price of my product, or increase the product, or reduce the variable costs, or increase fixed costs? What does that do to my profit? And so you're looking at alternative courses of action quite often, and you analyze the cost and profit of each of those courses of action. Now, it's very important too when I have multiple products, because all products do not contribute to profit equally. So I must watch the mix, determine that mix. And if I'm talking production, then which product do I produce, which is the most profitable product to produce? And of course, setting my selling prices, all a part of management's job, and this is a tool that's very useful to them. The basic concept here is that the information reported in a special format, the income statement. So what we're talking about is we take the income statement, which is the actual revenue and the actual expenses that has been presented from past year's operations. Now, those expenses we now call costs, and we analyze those costs and categorize them into which costs are fixed and which costs are variable. Then we reformat the income statement. We don't change the revenue, of course, but we change the listing of the expenses into those that are variable expenses and those that are fixed, and we introduce a new concept called the contribution margin. And here it is. Here's a cost, volume, profit income statement. This company, Vargo Video, sold 1,600 camcorders at 500 each, so 800,000. It cost them, in terms of variable costs, 300 for every unit they sold. And therefore, we have what's called the contribution margin. And recall, the contribution margin is simply the variable cost minus sales. Because variable cost changes in direct proportion, it changes in the level of activity being sales here, we can net the sales and the variable cost together and just focus on the contribution margin. Now we can do that in total, 320,000 here. We can do it on a unit base, 200 a unit. Now that 200 per unit is contribution towards fixed. And the question in is, how many do I have to sell in order to cover my fixed? In this case, it'll be 1,000. And what's left over after that, after I pass break even, each unit is contributing 200 to profit. And so therefore I can predict my net income at any level of activity here, knowing my variable cost and fixed costs. Again, here we have it more expansive. You see sales, and we've taken the cost of goods sold and broke it into the variable portion, and down below is the fixed portion, 120. We did the same with selling and admin, broken into variable and fixed. And now we have the cost, volume, profit in a format we can use to predict what future profit would be given a certain level of activity. All right, so now let's sign up for the quiz. Prizes will follow. They'll be in the mail later. Okay. No, we need more people than that. Nadia, where's Fatma tonight? All right, let's start the quiz then. Question 1 of 9. The CVP income statement classifies costs. Right, absolutely. Gross margin, that's financial accounting. We're talking contribution margin, and that is management accounting. Question 2. Contribution margin is the amount of revenue remaining after deducting cost of goods sold, fixed costs, variable costs. Yeah, good. We have more people join this time. Very good. All right, let's work through an example here. Blue Diamond Inc. sold 20,000 units and recorded sales of 800,000. Okay, so we know what the selling price is per unit. Making sales, the company incurred the following costs. So we have the costs broken out for us into variable and fixed. Cost of goods sold, selling them in. Prepare a CVP income statement and contribution margin per unit and the contribution margin ratio. So we take the sales, 20,000 units at 400 each, and we get 800,000 in sales. Now the variable costs are 432. So therefore the contribution margin is the difference between sales and variable costs. In this case, it's 368. Now, if we take 368 as a percentage of sales, we get what's called the contribution margin ratio. So the contribution margin divided by sales equals the contribution margin ratio. As I said before, a ratio means that item as a percentage of sales. So contribution margin as a percentage of sales, 46%. Now I could do it on a unit basis too. The unit cost to produce is of these units. The contribution margin would be 1840, and that is 368 divided by 20,000. Divided by the selling price, which would be 40, and you get 46. So in either way, you get the same contribution margin. Now the fixed costs are 208, so the profit here is 160. So that's what we can use now. We can use the contribution margin total, contribution margin per unit, which is 1840, or the contribution margin ratio. How do I use it? Well, I can use it to determine break even, target net income, and so on. And here we have Fargo, CVP, shows total contribution margin 320, and the company's contribution margin per unit is 200. Contribution margin expressed in the form of ratio is 40%. So now, if I want the break even in units, I simply take the fixed costs and divide it by the contribution margin per unit, which is 200. If I want to break even in dollars, I take the fixed cost and divide by the ratio. Okay, so in this case, the fixed cost in each case was 200,000, and the contribution margin per unit was 200, so my break even is 1,000. If I want it as a ratio, is 500,000. Well, you know, we sell the product for $500 each. So the break even in units, 1,000 times 500, you get your break even in dollars. All right, so that's how we use that to calculate break even. But we also want to determine what level of activity, i.e. sales, do I need to give me a certain profit. Well, that certain profit we refer to as target net income. Simply put, we add the target net income to the fixed costs and divide through by the contribution margin per unit if we want the answer in units. We divide through by the contribution margin ratio if we want to know the break even in terms of sales dollars. And when you get that, this is what you're looking at. You're looking at required sales in units, 2,250. And in dollars, it's 1,125,000. So at that level of sales, I will not only cover my fixed, I will earn a profit of 250. So that's how we use it, target net income. Required sales in units to achieve a target net income is oh, come on now. How come we only have two? Okay.
I pressed the wrong button.
Huh? What?
I pressed the wrong button.
Could not catch the answer.
Yeah, it was fast as well. I mean,
Okay,
Yes,
we only have
faster,
4
yes.
people comparing. All right. Continue on then. The next concept is the margin of safety. Now this is all review. This is from last week. The margin of safety is that level of sales beyond which we need to break even. Another way of expressing that is sales can drop by that amount before we are no longer profitable. That's the margin of safety. Now, to calculate it, you calculate it in dollars, but quite often it's expressed as a ratio of sales. So you take the actual sales minus the break-even sales, and that gives you the margin of safety in dollars. You then take the margin, if you want the ratio, then it's the margin of safety divided by sales. So this is what it would look like. Here we have expected sales 800 and break even is 500, so the margin of safety is 300. We take 300 as a percentage of 800 and we get 37.5, which means that sales, the economy in general, can fall as it has with this virus. And you notice when you go through the malls, those companies that had a low margin of safety, because they're no longer there, they're boarded up. When the economy drops a certain percentage, sales and all business drops by that much. And for this company, it has to drop 37.5%. But many companies are operating only at 10, 15% margin of safety. And therefore, margin of safety, when you're looking at companies, gives you an idea of the risk of investing in that company. A company with a larger margin of safety is less riskier than a company with a small margin of safety. So that's the way you look at the margin of safety. Okay. All right, question 4 of 9. The margin of safety ratio. Right, okay. 3 out of 5, I guess that's good. All right, now, Now that we understand how costs behave and we can predict break even, target net income, we can also create a number of different scenarios. We could say, what if I change my selling price? What if I invest in automation and replace labor? So I'm changing fixed costs and I'm changing variable costs. What effect does that have on the way I am? So first of all is understand the way I am now, and that is this. Okay, so the way you are now, sorry, unit selling price 500, variable cost 3, fixed cost that, break even, we've calculated. Okay, now what if a competitor is offering a 10% discount on the selling price of its camcorders? Management must decide whether to offer a similar discount. What would happen here to my break-even sales? Right now, it's 1,000. But if I gave a 10% discount, then my selling price would go down 50, but my contribution margin would also go down 50. And the effect would be that my break-even has gone up. I have to sell more units just to break even. How many more? A third more. Now that's a lot of sales activity because my contribution margin dropped 50. Sales dropped 50, but the variable costs remain the same, so the contribution margin dropped. So giving a 10% discount would be very difficult for us. All right, case 2. Management invests in new robotic equipment that will lower the amount of direct labor required to make the camcorders. Estimates are that total fixed costs will increase 30%. So they were 200,000 before. And the variable unit costs will decrease 300. Now the variable, the 30%, the variable was 300. So now you have to come up with the new fixed, the new variable, and the new contribution margin. The selling price remains the same here. So once you do that, this is what you're looking at. You're looking at fixed costs now increasing from 200 to 260. And the contribution margin, all right, has gone from 200 to 210. So I've increased the contribution margin. Okay, and my break even is lower. So this is a possible course of action that we may pursue. If my break even is lower, then that means I would be profitable, more profitable under this alternative than the way I am now. Okay, so this would be a viable alternative. What about number 3? Vargo, principal supplier of raw materials, has just announced a price increase. A higher cost is expected to increase the variable cost of camcorders by 25. The variable costs, remember, were 300, so now they're 325. So my contribution margin is going to go down. Management decides to hold the line on selling price, so it's still 500. And it plans a cost-cutting program that will reduce fixed costs by 17,500. Currently, we are getting a profit, a net income of 80,000 on sales of 14 camcorders. What increase in units sold would be needed to maintain the same level of net income? So you see, we have to bring in target net income here of 80. All right, so we got the selling price remains the same. The variable cost increases from 300 to 325. The fixed costs go from 200 down 17,005, and we have a target net income of 80,000. So then we have to figure out what number of camcorders will be needed to get the same income. So once we do that, here are the totals with this AHA slides. You can't click forward like you do on PowerPoint, so you have to show it all. Variable cost per unit increases. Okay, fixed cost decreases to 182.5. Contribution margin now is 500 minus 325, which is 175. So there's my 175. I must cover my fixed and give me a profit, and I need 1,500 units to do that. Well, the way I am now, I'm at 1,400 camcorders I'm selling. And in this scenario, I have to sell 100 more. Okay. Now, all of this, that's how we use the model, the cost, volume, profit, in a business environment case. And basically we play what if. What if we do this? What if we do that? Keep in mind we're planning the future courses of action for our business here. And so these are the tools we use to predict that. Okay, any questions? Now up to this point, we have calculated the break even for companies that provide one product or one service. What do we do for those companies, as many companies are, that produce more than one product or one service? Well, what we use is what's called the weighted average unit contribution margin. For example, now our friend Vargo Video not only sells camcorders, but they also sell televisions. Now, when we're talking about a company that sells more than one product, you see, each of those products has their own selling price. Each of those products has their own variable costs. Each of those products have their own contribution margin. But the fixed costs support all the products. You understand what I mean? Vargo's fixed cost of operating this business supports both television and camcorders. Vargo has its two products in the following units. Okay, so they sell 1,500 camcorders and 500 televisions. Now, a company has experience in sales. They know pretty well how much the mix is going to be. For every 5 cans of razor blades, there will be one, or shaving cream, there will be 2 razor blade boxes, what have you. In this case, Vargo knows that of the 2,000 units they sell, 1,500 will be camcorders and 500 will be televisions. So we simply say, okay, of the 2,000, what percentage would be camcorders? 75%. What percentage would be televisions? 25. Well, you can see that right here. For every 3 we sell here, we sell 1 of these. Every 3 camcorders, it's 1 television set. So now, the television sales, or the sales mix is 75-25. Now we use that to give the weighted average unit contribution. So the sales mix is the relative percentage in which a company sells its products, and we just figured that out. If a company sells 80% printers and 20% computers, it has an 80-20 sales mix. And this is very important in determining that sales mix. We assume it remains constant, and it usually does from year to year. So back to Vargo. What we know now is the sales mix of camcorders and TVs is 75-25. Camcorders has a selling price of 500, variable cost of 3, so contribution margin of 200. TVs has a selling price of 1,000, variable cost of 500, contribution margin of 500. All right, and the fixed cost, as I said, 275. The fixed cost is the cost of capacity. It's the rent and the AC and the fixed cost of having a salesperson. And that is common for both. The fixed costs support both products. So you cannot divide the fixed costs into so much for camcorders and so much for TV. You cannot do that. But what you do is you calculate what we call the weighted average. We simply take the contribution margin of camcorders and weight it by the percentage mix, 75, 200 times 75%. And we add the contribution margin for TVs times the sales mix of TVs, 25%. And we come up with the weighted average contribution margin. And there you have it, 275. Now that's neither camcorders nor sales or televisions. It's the weighted average. So the fixed costs are common to both. We now have the weighted average. We can proceed to determine the break even in units because this weighted average is a unit contribution margin. So we simply take the fixed cost, 275, divided by the unit, the weighted average unit contribution margin, that gives me 1,000 units. Now that's not 1,000 camcorders, that's not 1,000 TV, that's 1,000 of both combined. So therefore, we have to break it back into
75.
right 750 for camcorders and 250 for televisions. You gotta add. Now we can do the same thing with the ratio, and actually a ratio is much more effective and efficient here rather than units. But the fixed costs support both products. Now we come up with a weighted average unit contribution margin. Oh, I'm sorry. I just did that again. Yeah. Okay, 275. Now we want it in ratio. So a company like Carrefour has thousands of products. They use ratios. And you can compute it by divisions or product lines. You don't do it by individual products. So as an example, here we go. We have a company, Kale Garden Supply, has two divisions, indoor plant division and outdoor plant division. Now the sales for indoor, 200, and the sales for outdoor is 800. So together it's 1,000,000. So you see we got our 80-20 right there. The percentage of indoor is 200 divided by total sales, 1,000,000. And outdoor, 800 divided by the 1,000,000. So that gives us our sales mix right there when we have two. Now the variable costs, of course, the selling price is one. The variable costs, 120 for indoor, 560 for outdoor. So the contribution margin is different for both. For indoor, it's 80,000. For outdoor, it's 240. And so therefore, the total contribution margin is 320. Now what we have to do is convert this into a ratio. So we take 80,000, remember contribution margin ratio, contribution margin as a percentage of sales. So 80,000 as a percentage of 200, I get 40. And for outdoor, I take 240 as a percentage of sales, and I get 30%. Weighted average is going to be 32. So now I simply take the contribution margin ratio times the sales mix to come up with the weighted average. And then I use that to do my break even. Whoa, did I miss a slide here? There, okay, good. So contribution margin ratio for indoors, 40%, sales mix 20, outdoors 30, sales mix 80, I get weighted average 32%. I take the fixed costs and I go back, and in the problem they had the fixed costs where they should have told us the fixed costs. They didn't. Okay. Oh yeah, right here, total fixed cost 300,000. So I take the fixed cost and I divide it by the weighted average contribution. I get a total sales dollars of 937.5. Now that's a combination of both indoor and outdoor. And therefore, if I want to determine how much is indoor and how much is outdoor, I simply take the break even for both of them, and I bring back the sales mix. 20% is the indoor, so therefore 20% of 937,500 is 187.5. And 80% is outdoor, so 80% of 937,500, and the outdoor break even, the manager on the outdoor has to achieve 750 in plant sales in order to achieve the break even for that division. Now you can see if the sales mix changes, then the weighted contribution margin ratio will change and a lower break even. So you see the outdoor has the higher contribution margin and ratio. Oh, I'm sorry, who has the higher contribution margin? The indoor one has the higher contribution margin ratio. So if sales goes up by from 20% to 30%, the higher contribution margin ratio is being more sold, therefore is selling more, therefore the break even goes down. All right, players, let's join in. Wow, Fatma is with us. Welcome, Fatma. Okay, let's see how you do.
Thank you, Doctor.
Sales mix is what do you think? Yeah. Relative percentage in which a company sells its multiple products. That's what sales mix is. All right, the next question. I say, at any level of sales, net income will be higher if. Yeah, I'm glad to see that. That is great. That's exactly the situation, and everybody knows, and marketing people know this, and people who lay out. Well, you notice you go shopping, you go to Carrefour, and you're going for bread. Where's the bread? It's at the back. All right. What's at the front? Well, Carrefour is pushing the higher contribution margin units to you. Children's clothes, DVDs. Think of how much it would cost to produce a DVD and what they sell it for. Okay. Children's clothes, of course, they sell for the same price as our clothes, but they're half the material. So companies continually push the product that gives them the highest contribution margin. You go for your breakfast cereal. Well, the one at eye level is the cereal that they get the highest contribution margin, not profit, contribution margin. We're not talking profit. All right. So they always have it. And when you go to checkout, what do you have? Chocolate bars and gum and things like that. Soft drinks, all units that offer a high contribution margin. I had a friend, or I still have a friend, I guess, manages McDonald's in Canada. And he basically told me that these companies like McDonald's and Burger King give away the hamburger. And what he meant by that is the variable cost to produce a hamburger is pretty close to what they sell that hamburger for. Where do they make their money? They make their money on the drinks, which they want to upsize you with. They make their money on the fries, which they want to upsize you. And they also make their money on, those apple pies or donuts and things like that. That's where they make their money. Because those units, high contribute, they don't upsize you on the hamburger, do they? They upsize you on the fries and the Coke. So smart companies are always pushing the product. When they have many products, they're always pushing to you the product they earn the highest contribution margin on. Okay. So you check the selling price. It's got nothing to do with the lower price or higher price. It's the contribution margin. Anyway. All right. The last topic in this area is the cost structure of a company. Now, we started off looking at the income statement of Vargo, and we looked at the actual expenses, and then we broke those expenses into fixed and variable. And if you went back, you would see that I think it was 680 expenses, and yeah, and 480 were variable, and 200 were fixed. Well, you see, if you took a percentage of variable to the 680 and fixed to 680, you get the percentage of variable cost and fixed costs. And that's what cost structure is the relative proportion of fixed costs versus variable costs. So this has a significant effect on profitability. Yeah, I can increase profitability by increasing sales, lowering costs, all of that. But also my cost structure has an impact on my profitability. And senior management chooses that cost structure very carefully. So now we're just going to go through an example of that. We're going to have two companies here, Vargo and their competitor New Wave. They both make camcorders. Okay, they both sell for the same price. But Vargo is a traditional labor-intensive company. I have a lot of people who are assembling these things and cutting and gluing and doing all kinds of stuff. New Wave, though, has an automated manufacturing system, so it's capital intensive. Vargo is referred to as labor intensive. New Wave is referred to as capital intensive. Now, we have sales of 800,000 for Vargo and 800,000 for New Wave. So together, you can see there's 680 in expenses, 480 in variable costs for Vargo and 200 in fixed costs for Vargo. That's Vargo's cost structure. When you look at New Wave, you see that their variable costs are 160 at that level of sales, but their fixed costs are 520. So a completely different cost structure. A cost structure that has a lot of fixed cost relative to variable costs, whereas Vargo has a lot of variable costs relative to fixed costs. So what does this mean? Well, let's now look at the effect on the contribution margin. So the contribution margin is 320 for Vargo and 640 for New Wave. So if I want to look at the contribution margin ratios, it's this way. I take the contribution margin for Vargo, 320, divided by the sales, 800, and I get 40%. But look at New Wave. They get a contribution margin ratio of 80%. So they have double the contribution margin ratio. They also have more than double the, or almost double the fixed costs, more than double the fixed costs. So what does this do? Well, it means New Wave contributes 80 cents of net income for each dollar of sales, while Vargo contributes only 40 cents, half of that. New Wave cost structure relies on fixed cost and is more sensitive to changes in the level of sales. Look at the break-even point. Now the fixed cost for Vargo, contribution margin ratio, you can see when we the break-even point is a lot higher for New Wave because they have the fixed cost is a lot higher, but the contribution margin is also a lot higher. But nevertheless, the break-even point is 650. So New Wave needs to generate 150 more in sales than Vargo just to break even. New Wave is a riskier company because of the fact it has a lot of fixed costs in it. Okay, now, what's the effect on the margin of safety? Well, the margin of safety is simply the actual sales minus the break-even sales as a percentage of actual sales. The margin of safety ratio is 38% for Vargo, but only 19% for New Wave. So you see, New Wave is more sensitive to a drop in the economy. The economy just has to go down 20% and New Wave will be in a negative position. The difference in rate reflects the difference of risk. So the more fixed cost you have in your cost structure, the more riskier it is. That is, Vargo can sustain a 38% decline in sales before operating on its loss, where New Wave only half of that. Keep in mind, New Wave has twice the contribution margin ratio, but the margin of safety is half. So operating leverage is the extent that net income reacts to a given level of changes in sales. Higher fixed cost relative to variable cost causes the company to have a higher operating leverage. When sales revenue are increasing, high operating levels will give you large profits. But the opposite happens when sales are decreasing. When sales revenues are declining, too much leverage can have a devastating consequence on the operations of a company. That's why management pays so much attention to the percentage of variable costs to fixed costs. This is called a degree of operating leverage. Now, in managerial finance, you'll come across what is called financial leverage. So in every company, you have financial leverage and you also have operating leverage. And what the degree of operating leverage does, it provides a measure of the company's earning volatility. And how do you compute that? You divide the total contribution margin by the net income at that point where the two were equal. Remember, sales of 800, net income of 120. But you see, the contribution margin is higher under New Wave than it was under Vargo videos. Net income's the same. So you can see that the degree of operating leverage is twice Vargo for New Wave. New Wave is double what Vargo is, so it's much riskier. New Wave's earnings will go up 2 times faster than Vargo with every change in sales, but it will also go down 2 times faster when sales decline. So that's what operating leverage is all about. Degree of operating leverage. And it only comes about when you have higher fixed cost than variable costs. So management is very, very careful when they analyze their cost structure because they know the effect that cost structure has on break even. They know the effect it has on margin of safety, and keep in mind margin of safety is a measurement of risk. But they also know that it has a major impact on profits without increasing sales, and that is just because once you have the higher contribution margin. Once you cover that fixed, then your profits will go up very quickly. But if you can't cover that fix, then you're in trouble. All right, last 2 questions in this area. Cost structure. Oh, okay. That's right. One more. Oh, two more, sorry. Reducing reliance on human workers and instead investing heavily on computers and online technology will it will certainly change your cost structure. Right. Oh, no. It's the opposite. It will reduce variable costs because variable costs are human workers. And will increase fixed costs because fixed costs are machines. And therefore the depreciation on those fixed costs remain regardless of what level of activity is. The last question in this area. The degree of operating leverage, and you must know that for the quiz. Okay.
5. Current attempt in progress. Sheridan Tools manufacturers.
Okay.
Why? Did I get it wrong?
No. I just
Tools
laughed when you
manufacturers.
said current attempt in progress. That's all. Okay.
I just mindlessly read.
Right. Okay.
Okay,
Go ahead.
lawnmowers, weed trimmers, and chainsaws.
Right.
Its sales mix as a percentage of total units and unit contribution margin are as follows. Lawnmowers and weed trimmers. The unit contribution margin is given. That's $34 for lawnmowers, $23 for weed trimmers, and $37 for chainsaws.
Right.
Okay, the fixed cost is $4,410.
Okay.
Now we have to compute the number of units of each product that the company must sell in order to break even under this mix.
Right.
Okay, so the break-even points in units have to be computed. Now, if I have to answer this, I would have to refer back to the slides because I did not memorize the formula.
What
If someone
formula?
tells me,
You just take the sales mix by the contribution margin. That's all.
so
You weight
that
the
is,
contribution margin by the sales mix.
what is that again?
You weight the contribution margin by the sales mix.
So that is $34 multiplied by 0.20%. Oh no, I have to add all of the contribution margin up and then
No,
take.
no. Do them individually. Do them individually.
So
that will be
20% multiplied by 34, then 50% multiplied by
Right.
23rd.
Okay.
Right.
Then
34 multiplied by 0.2. That is 6.8 for lawnmowers.
Okay.
Correct?
Yeah.
This way, right?
Yes.
23 multiplied by 0.5. That is 11.
Times 5.
And then
Right.
multiplied by 0.3. That is 11.1. So I think the class would have different numbers in their system.
Yeah.
So just multiply.
But
No.
this is not the answer.
That's not the break even.
No. You just memorize this, then you will take.
Now
30.
add those together and you got your weighted average contribution.
So it will be total 30.3.
6.8 plus 11.5 plus 11.1. That is 29.4.
Okay, keep that aside. Now get those numbers out of there. 29.4 is your weighted average contribution margin. Get that. So you divide the fixed cost by the weighted average contribution. What do you get?
Okay, fixed cost by the 29.4.
Right.
So let me do that. 4,410 divided by 29.4. That's 150,000.
How much?
150,000. 4,410,000 divided by 29.4. That is 150,000.
divided by point.
29.4.
No, 29.4% divided by 0.294.
Okay, sorry.
Why, Doctor?
Contribution margin ratio, or the contribution margin.
But he
Oh,
already.
29.4. Okay, I'm sorry. You're right. I was
Yes,
thinking.
he already when the first.
Okay,
step.
so how many did you get?
150,000.
Yes.
150. Okay, how many are going to be lawnmowers?
Then
we have to multiply 150,000 multiply by
the
0.2.
percentage.
Was
Exactly.
230,000.
Yes.
Exactly. How much will be weed trimmers?
50%, so that is 775,000.
Okay, and how much will be chainsaws?
There you go.
Good. I'm sorry, I
Yeah.
was thinking ratios.
We got it right.
Ah,
hope everyone-
okay, move on then. Any questions? No?
No.
All right, number 2. We got 10 out of 10 on that one. Number 2, the same thing, basically. Only
Yeah.
you have to dig out.
Okay.
Okay, read it. Never mind. Currently attempt in progress. Go on.
The 3 different models of mosquito zapper. Model A12 sells for $53.
Yeah,
Has a unit variable cost of $37.1.
right.
Model B22 sells for $106
Yeah,
and has unit variable cost of $74.20.
right.
Model C124 sells for $424 and has a unit variable cost of $318.
Right.
Now the
Now
sales.
notice they did not give you the contribution margin, but you need the contribution margin. Okay.
Yes.
Continue.
So
Now, the sales
Now-
mix.
the sales mix as a percentage of total units of the 3 model is 60%, 15%, and 25%.
Okay, good.
That'd be nice if this was
You
a
need the
table.
fixed costs now?
Yes. The company has fixed cost of $269,000, 346.
Okay.
How many units of each model must the company sell in order to break even? We need to
Right.
find break even per unit, per model, and total break even. So
Okay.
So first the contribution margin per unit.
Get the contribution margin for each one.
Selling price minus a variable cost.
Right. So what's it for A12?
A12, where is it? A12 has a selling price. A12 is $53
Right.
and minus variable cost is 37.1.
Okay.
So the contribution margin for A12 is 15.9.
Okay, write that down somewhere.
Yeah, I wrote it down. Okay, now
Okay.
for B22, it's 106 minus 74.2. So
Right.
that is for B22, it is 31.8. Now for the C124 model, it is 424 minus 318. So it
Right.
is E24, C124 is equal to $106. So I have written all of that down.
Okay, now A12 times 60%. Contribution margin times 60%. B22 contribution margin times 15%.
Then we will add the 3 of them.
That's right. And C12, what's that? C124, 25% the contribution margin. Now you add them up. And that's your weighted average contribution margin. Now that's per unit.
Doctor, can you please repeat after we find the contribution margin for each? What do we do?
Yes. You need a contribution margin for each product.
And then?
and you multiply it by the sales mix for that product.
Okay.
No, don't put it in there yet. What are you doing?
I added it up, so I don't know. Okay.
Did you get the, okay, what did you add up? What did you get?
Yeah, so if we did it right,
No,
okay.
No, you take
So
that.
what I did basically is that I took the contribution margin, which is the selling price minus variable cost, which is the
Right.
contribution margin per unit, and then I multiplied it by the sales mix.
Okay.
So for example, for A12, the contribution margin was 15.9, and a 60% of 15.9 is 9.54.
Okay.
That's how I got.
Yeah, but it doesn't go there. That's, what's the break? Okay, what's it? How many units must be sold of each? Okay, put the 9.54 on a piece of paper somewhere.
Yeah,
Put
I
the
already
4.77 and add them all up to 26.5. What do you get?
40.81.
Okay, put that 40. Okay, take those numbers out of there. Okay. All of them, 40.81. Okay, take that. All right, that's your weighted average contribution margin. Now you take your fixed costs and you divide it by that.
Oh, okay. So I have to take the fixed cost, which is 269,346 divided by
The weighted average contribution margin per unit. A unit, the weighted average unit contribution margin.
So that's not 40. That is not a sum of all of that, but the individual, right?
It's 40 point, what you gave me,
40.8.
Yeah.
600 and 660, the number.
600.
No, 6,000. 6,600.
All right, that's the total break even. Put it in down there. Number of units. Okay, now how many are A12?
Oh, okay. Now I have to multiply 600.
Yeah.
Okay.
Okay.
It's easier
Yes.
with the Excel sheet, Doctor.
Pardon me?
It's easier with the Excel sheet.
Ah,
Yeah, it is. Okay, how many are B22s?
I would agree on Excel.
Okay, well, we don't have Excel, but how many are C124s? Okay, that looks about right. All right, are you getting the idea of the weighted average contribution margin you have to calculate into the fixed cost? Get the break even in total and then break it down. Any questions? Now, you're going to get a question like that, that's for sure. All right, next one.
I don't know. It is not showing. Okay. So next one. Okay.
Why, what's the matter? Yeah, 3. Okay, current attempt in progress. Go ahead.
So the company has sales in 2021 of 1,320,000 on 60,000 units.
Right,
Variable costs totaled $792,000 and
Right.
fixed cost totaled $440,000.
right,
A new raw material is available that will decrease the unit variable cost by 20% or $2.64.
right,
However, to process the new raw material, fixed operating cost will increase by $88,000. Management feels that 1/2 of the decline in unit variable cost should be passed on to the customer in the form of a sales price reduction. So that's a discount.
Yeah.
The marketing department expects that this sales price reduction will result in 5% increase in number of units sold.
Okay.
Prepare a projected cost CVP income statement for 2022, assuming the changes have not been made.
All right, so go back to the first line you have here. What month is this? What? Did they give us a time period? CVP income statement.
For 2022, prepare a projected income statement for
For
2022.
the year.
Okay,
For the
yeah,
year.
for the year then. Put it for the year.
The year ended December 31,
Okay.
or is it, there is multiple choice here. It's also December 31, 2022. So I don't know.
No, for the year ended December.
That's right. It's a time period statement.
Mm.
Okay, you start off with, yeah,
Yeah.
you got it up there.
So
This year, 1, 3. I have it different.
Yeah, you're different. Okay, now divide that by 60,000, you get your per unit. Okay. Is that what you-
variable cost.
Okay, variable cost, 792. Okay, divide that by 60,000 and get your unit. What? 13.2, okay. And what's next?
Contribution margin.
Contribution margin.
Very good. Subtract.
320 minus 792.
Right.
528, 0. So also that can be 22 minus 13.2.
Right.
Okay. Now,
Fixed cost.
Right. Fixed costs.
and fixed cost would be
For
here.
yeah.
Fixed cost is 440.
Right.
So
Oh my
this
God.
is net income.
528 minus 440.
Right. Okay. Now, prepare the income statement. Well, you're making a
No,
smaller.
no.
Oh, sorry.
Okay, thank you.
With the changes. Okay, same date, same day.
It will be the same, Victor. The year ended December.
Now, wait a minute. The sales, they said, went up 5% in units or what?
Number of units sold. So it would be 60,000 multiplied by 1.05. So
Right.
63,000.
63,000, yeah. Is the selling price change?
Yes, they are going to give decrease the unit variable cost. If they want to give decline in unit would be passed on to in form of sales reduction, sales price
Right.
reduction. Management feels that 1/2 of the decline in the unit variable cost should be passed on to customer in the form of sales price reduction. 1/2
Yeah.
of the variable cost. That's what.
2.64.
Yeah. So one half of 2.64
Right.
divided by 2. So 1.32.
Right.
So so from $22 we have to minus 1.32. So that is 20.68. Am I right?
Yeah, sounds good.
Okay, then we have to multiply that
By
by
63.
63,000, which is
Yep.
giving us a sale of 1,302,840.
Okay. Put that in there.
Can you repeat that part, please?
He's
Sure.
going to do it again. 1,000,003? No, no.
Yeah, wait a second. Let me 20.64. Yeah, so I'll repeat that. So what we have here is we are expecting a increase in 5% of units, so which is 60,000 multiplied by 1.05. So that's giving us 63,000 units. However, the unit selling price is going to change by half of this value, because it says here the management feels that 1/2 of the decline in the unit variable cost should be passed on to the customer. So the
Right.
unit variable cost is 2.64. And management feels half of that should be passed on to the customer. So we have the unit price, $22 here, minus half of this value. When I'm highlighting on the screen, you're able to see that, right?
132, yeah.
Yeah.
Okay.
Okay, so 22 minus 1.32 gives you
Put
the
it
number
in.
20.
Yeah, 20.68. Now multiply that again by 63,000. I think it should be higher than what you got there.
So 20.68 multiplied by 63,000. It is, I'll just copy paste it as it is. So from the calculator, it's the same number.
It is? Okay. All right, then go to the variable cost, did they change?
Yes, so the variable cost
Right.
now is has increased by 20%. So I can take
No. Decrease.
decrease, sorry, decrease.
So you take 13.2 and subtract 2.64.
Oh, okay. I
Take
was
the variable cost per unit and subtract 2.64 and multiply that by 63,000 units.
22 minus 2.64, that's 19.36.
That's what? No. Oh, no. 13.2 minus 2.64, it can't be 19.
No, 22
No,
minus.
variable costs.
Oh, okay, sorry. Yeah, sorry. Yeah, 13.2 minus 2.64.
Right.
10.56. Sorry.
Right. Now multiply that. Multiply that by 63,000.
That's 665.
Okay. Now you're off to the contribution margin. And you have to deal with the fixed cost.
Minus 665. 80.
Good. Now, has the fixed cost changed?
No,
Oh.
fixed cost is the same.
Okay, there you go. Right, now the profit has changed.
4637, 560 minus 440.
Right. Now, assuming those numbers are right, would I go for this?
Yes.
Why?
Net income increased from
Yeah.
88,000 to 197,000.
Yeah. Okay, see if it's correct. Are your numbers correct?
But it says that the fixed cost increased.
Oh, it did
Yeah.
say the fixed cost increased, did it?
Yeah, by
Where?
88,000.
Ah,
Yes.
we
Now
missed
add that to the 440
that.
and almost a half that profit is gone.
Yeah, so it's 528. Yes.
Yeah,
Thank you.
but you're still more profitable with this one.
So minus 637 is 109.
Right.
60.
Okay.
Yes.
Okay. All right. Any questions? So you see, these are the changes we would make as managers because our profit would go from 88, we predict, to 109. That's maybe a 20% increase, right? 16,000, 17, yeah, 20% increase. Any questions? All right, Shaheen, continue.
Yep. Now,
All right, we're at the cost structure now.
the single column CVP income statement shown below are available for Clara Vista Company and Sandhill Company.
Okay, notice the sales is the same, the profit is the same, but the variable costs, the total costs are the same. You add 250 and 152, you get 402. You add 49 and 359, you should get 402. The costs are the same, but the percentage variable cost is of the total is different. So you see they have different cost structure, even though they have the same expenses in total. At this level, they have a different cost structure. So now, yeah, it says compute the degree of operating leverage. Now the degree of operating leverage is the contribution margin divided contribution margin divided by the net income. So what's the contribution margin for Carla Vista?
That is $252,000 divided by
By 100,000, yeah, gives you 2.52.
2, and this would be 4.53.
Yeah, 453 divided by 100,000. Okay. So now you see that Sandhill is much more leveraged than Carla Vista, which means it has more high fixed costs. It's using leverage. Now, if the increases go up, if there's an increase in sales, Sandhill's profit will increase more than Carla Vista because the leverage is higher. But if it goes down, it decreases more. So let's prove that. It says, assume the sales revenue increases by 10% due to a 10% increase in the number of units sold. So there's no increase in selling price. It means we are selling 10% more because of the number of units. So take 10% of the sales. They both have the same sales now.
Yeah, so 502,000 multiplied by 1.1. So that is
1.1, right. And what do you get? All right. Now, wait, this is going to be different. Now you're going to have to figure out what is the variable cost ratio for Carlo. Because the variable cost ratio will remain the same.
okay. So I'd have to find that ratio by dividing. I don't know if it's accurate.
Divide what?
150,000 divided by sales.
No. Divide the variable cost by sales.
Yeah, that is 250,000 divided by 502,000.
How much is the variable cost? 250, divided by 502. Okay, what do you get? What percentage do you get?
59.8.
Okay, now down here, take 59.8 of the sales.
Okay, so
The variable cost ratio remains the same. Does everybody follow? The selling price didn't change, therefore the variable cost as a percentage of selling price remains the same. So if sales goes up 10%, variable cost also will go up 10%. So take 250 times 110 and you get it. Now for Vargo, they too will go up 10%, the variable cost. You can figure out the variable cost ratio now, or you can just take 49 and take 1.1, 110%. Okay, now your contribution margin will go up 10%. Their contribution margin was what? Okay, just subtract them then. Okay, good. All right, now the fixed cost, and remember they both have different They each have different fixed costs.
We take the same numbers.
Fixed cost, yeah, 152. Right. It hasn't changed. This is just cost structure. 353. Now do the profits. Very good. Okay. All right. Now, let's make sure the numbers are right before, but don't go away. I want to talk about this. All right. Good. Good. Okay. Go up. Go back. Okay. Look. They both have 100,000 in profits. You see that?
Yep.
A 10% increase. If I have a leverage at 2.52 and there's a 10% increase, then I'm going to get 2.52 times that 10%. I'm going to get a 25.2% increase in my profits. So go down to my profits. And what do I have? 125, 200. You see, I have a 25.2% increase in my profits. Now, I'm going to have 4.53% increase. So if I have 10 for Sandhill, if their sales goes up 10%, their profit is going to go up 10 times 4.53 or 45%. And look what happened. Their profit went from 100,000 to 145. Now, is everybody paying attention? The sales are the same. The sales are the same, but look at the difference in profits. Beyond that break even, you see at 100,000, they're both equal. But beyond that, the one with the higher degree of operating leverage, their profit is going to go up. For every percentage increase, their profit's going to go up 4%, 4.53. For every percentage increase, Carla Vista's profit is going to go up 2.52. So we had a 10% increase. So Carla's profit went up 25.2%. And Sandhills went up 45.3. That, my dear friends, is what leverage is all about. They sold the same amount of units and they sold them for the same selling price. But because they have a different cost structure, they have a tremendous difference in profit. Does everybody understand?
Is it a straight multiplier?
Hey?
Is it a straight multiplier like 1.252 and 1.453? Or is it because there is a 10% increase? So that 10% also factor into the net income?
Okay, let me say it this way. Every 1% increase in sales, there will be a 2.52% increase in profit for Carla. But there will be a 4.53% for Sandhill. So in this profit, the profit went up 10%. So Carla's profit goes up 10% times 2.52, which is 25.2%.
Okay.
You see it?
Yeah.
Okay, that's the purpose of this question, to demonstrate leverage. Any questions? That's what that's all about. Okay, I think we have one more similar, I'm not sure. All right, you're doing, yeah, okay. Now, this is manual system and computer system. Okay, you want to read it?
Yep. So Juarez, Mexico is contemplating a major change in its cost structure. As of now, all of its drafting work is performed by draftsmen. Okay, Rafael, Columber's owner, is considering replacing the draftman with computerized drafting system.
All right.
However, before making the change, Rafael would like to know the consequence of the change, since the volume of business varies significantly from year to year. Below is the CVP income statement for each alternative.
Alternative, yeah. Okay, now look at the sales, the same, 1.620, and profits the same, but the cost structure is different. Now, manual has more variable, less fixed. Computer will have more fixed, less variable. So what's the degree of operating leverage for manual? Now you contribution
margin divided by net income.
That's right.
So 324 divided by 240. That is one manual would be 1.35.
Right.
Then 972,000 divided by 240,000. That is 4.0.
And it has, look at, so for every percentage increase in sales using the manual system, my profit will go up 1.35. 1% increase in sales, 1.35% increase in profit. But the computer system, 1% increase in sales, the profit will go up 4%.
Okay.
That's how you read that. Okay, go down, go down. Now, what effect does it have on my margin? Is it margin? Oh, net income. Calculate the increase in net income for each alternative if sales increases 128,000 due to an increase in the number of units. Now, what is 128,000 as a percentage of 1,620,000?
So that'll be 128,000 divided by 1 million. So that's a 7.9%.
Okay, 7.9, even, right on?
7.
Okay. What kind of percentage increase is that?
That is
Right?
1.079 after the multiplication factor.
Okay, wait, do again. What's 128,000 divided by 1,620,000?
Yeah, 0.079.
Hmm?
0.079.
0.17?
No, 0.079.
0.079, okay.
Yes.
0.079, is that what you're
Yes,
saying?
0.079. Yes.
Okay, all you have to do to calculate the increase in profits is go down, multiply that, okay, the manual system, an increase. Well, actually, all you have to do is take 0.79, is it 0.079 times 1.35, and the profit will be 240 plus that.
No, so net income also would increase by 0.079, correct?
No, it'll increase by more.
Because of the
It will increase by 0.79 times 1.35.
So okay, so when I'm using a multiplication factor, I have to multiply 1.079.
1 point. What do you mean 1 point? 0 point.
By 1 point.
Are you saying it's 1.079 or 0.079?
No, it's 0.079.
Right. Okay, 0.079 times 1.35, and that's the percentage increase in profit.
Okay, that is yeah, I got it. So that is 10. 10. Are you with me? Are you with me?
What?
Yeah, so 0.079 multiplied by 1.35 is equal to 0.106.
0.106.
Yes. So that much
I don't
would be
think
the
so.
increase.
I don't think so. I don't think so. 1.35 times 0, okay, times 1.079, right? What do you get?
No, it's not 1.079.
Yeah, it's 1.35 plus 0.079%. So if you take 1.079, you get the new number. What's the new number? No?
1.35 multiplied by 1.079, or should I multiply?
Yeah.
Then it's 1.45.
1.5?
456.
Okay, then you multiply that percentage increase to the 240 profit. Okay,
Yes.
what do you get? What's the new profit?
So I'd have to do the same for the other number as well. 1.079 plus 4.05 plus 4.5.
So what's the profit? No, they just want the profit increase. How much? Not the new profit.
Oh,
What's the increase in net income?
oh, then I'd have to compute that again. Just let me just compute that again. So just 1.079 plus 0.0135. It's 1 into 240,000. That's giving me 262,200 minus 240,000. So that's 22,200. That's increase here, the manual one. I don't know if this is correct, but I might get it wrong. Right. Okay, so in this case, what is 1.079 plus, sorry, it's a multiplication, right? Now what's confusing for me is the 0.079.
That, okay, 0.079 is a percentage increase. 128,000 increase in sales. So that's the increase in sales. So if you want to, you multiply that. Okay. You got your degree of leverage. What's your degree of leverage?
Degree of leverage is 1.35 and 4.0.
Okay, 1.35. So for every percentage increase, yours is going to go up 1.35. Okay, so the profit is going to go up by 1.35 times 1.079. What's that?
Okay, now I understand. Okay, so 1.35 multiplied by 1.079 is equal to 1.45.
1.45. Okay.
Now,
so that, yeah,
I have to multiply this 1.456
by 240.
Then I have to minus the amount which I'm getting.
Yeah.
240.
Okay. Right, to get the increase.
Now
Yeah, no, you probably had it right there. 22,000. What's that?
no, 22,000 was not a multiplier of, I did not multiply 1.079 by the manual system, which is 1.35.
Yeah.
And then I did not.
Times 128,000, I guess.
Yes.
Okay, what'd you get? 22,000?
No, 1.45 times.
Okay. Well, I
No.
think I'm confusing the rest of the class. Okay, the profits will go up by, no, it won't be 109,000. It'll be 20,000, something like that.
20,200.
Yeah, probably. Okay, do the same now for computerized system.
Yeah.
4.079 times percentage increase in sales. Percentage increase in sales was 0.79, 0.79, 0.079. So for every increase in sales, the profit's going to go up 4.05. All right, so multiply 4.05 times 1.079. What do you get?
4.3.
Ah, okay, now multiply that by 128,000. What do you get?
500.
500? No. What would it be? Go down. 128,000 times 4 point whatever. Well, maybe, I don't know.
I don't know. Fatima told she would help me. Where is she now?
She's not helping you, eh?
I'm trying to fix my numbers.
No, but then if you fix the numbers here, your numbers would fix by itself.
All right, for every percentage increase, so sales have increased by 128,000, right?
Okay, then.
Over 1,620,000. Okay, so 128,000. If it's going to increase 128,000, that is a 0.079%. So that's a 0.0979% times 1 point, was it 35 or 1 point?
Yeah, 1.35.
Okay, times 120 times 128.
128,000.
Yeah.
So multiply by 20%.
Not 20%.
For me, it's 20%. Look.
Is it 20?
How much percent you have from contribution margin divided by sales multiply 100?
Contribution margin.
The PV ratio, yeah.
Okay, well, you want to do it another way? Let's, okay.
I
Take the
did it
manual
like
system. Take the manual system. What's the new sales?
New sales is 100 and. Yeah, go ahead. Go ahead, Fatima.
No, continue. I'm confused now. Please continue. Sorry.
Okay, maybe we better leave this. I don't want to confuse you. Let's forget about this, okay?
No, but doctor, what if this comes for exam?
No, it's not going to be on the exam.
Okay, thank you, sir.
Okay, forget it. That's
No,
it for tonight then, all
No, I'll
right?
try to solve it after the class. I think this is pretty.
All right, okay, if you want to solve it, let's go. All right.
Doctor, if we
Take
don't,
the new sales, you got manual there? Okay. Have you got this in your Excel?
Yes, I can make it in Excel right now.
Okay, put in the Excel.
Yes.
Sales, 1,620,000 plus 128,000. What do you get?
What is that? Because I don't have a view of the numbers. See those numbers, Fatima.
Make it 2 windows. My number is different than yours. Yeah,
Yeah.
2 windows.
No, can you see the Excel sheet now?
Yes.
But you have to.
I can't see it. No. Where
You can
is
see.
it?
Just
Oh, wait a minute. Yeah. I see it. Okay. All right. First
Take
of all,
the
make
page,
that,
just
make
like
it manual. Go up manual. Okay. All right. Okay. Okay, go up one cell, go into 1B, B1, go to B1, put that manual. B1, manual. C1, compute, COM, okay. All right, sales.
Here?
No, down below, sales, manual.
The number is, I don't know if this works. I'll try this.
No, 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 no.
Okay.
No, get it out of there. What's the sales?
It is 1,620,000.
Plus 128. No, plus 128.
Okay.
Right. Okay, put that in the computer too, same sales. Okay, variable cost. VC, just put VC, okay. Okay, now go back to your problem. Now take variable cost as a percentage of sales for the manual. What's the percentage? No, get that out of there. Just give me the percentage.
Okay, variable cost as a percentage of?
Go back to the problem. Variable cost as a percentage of sales.
Variable cost as a percentage of sale. That is, wait a second.
What is it?
It's equal to this one divided by this one.
No.
So-
Okay, all right. No, okay.
Here. Yeah, here is it.
What is it?
So this is
No. 74? Okay, 74.1. All right. Okay, now take 74.14 as a percentage of 1748. You need the variable cost. Okay. All right. Put VC beside that. VC. Okay, now go to computer. Go up one. Okay. Go back to the problem and get the variable cost for computer. Right. Now take that as a percentage of sales of 1620. Wait a minute. 1620. Okay. Now wait a minute. Okay. Wait. Whoa. We made a mistake. Go back. That's a problem with Excel. Okay. Take that 1296 out of there. Take all of that out. Out. Delete. Go up. Delete. Okay, delete. Okay, go way over to G here. G. No, leave VC there. Okay, G. Equal. Okay, now go back to the problem. 1296000 divided by 162000. What percentage is that?
16. So what's the number again? 16.
Go back to your problem. Yeah, 16, whatever.
A second.
162.
A second. Let me copy those numbers so that it's here.
Okay, good. Yeah, okay. What percentage is that? You don't, did you have equal in there? Yeah. You have the right divide? Okay.
Because of I copy paste.
Oh, get a calculator, Shaheen. This is getting too complicated.
Oh, here,
80%. All right, wait, stop there. 80%. Take 80% of one. Okay, right now, 1748 times 0.8. Okay, times 80%. Well, we don't want it as a percentage. We want it as a number. Did you times it?
No. Yeah, here you go.
Is that 80%? Okay, good. Take out the 0 zeros. Okay. Okay, now go to J column or I column, any column over there. Okay, do the same thing again. Go back to your original problem. Take 1620 and divide 648. Copy 648,000. Copy it into your, okay, put it anywhere. Okay. Okay. Now go off into another column. Okay, so divide. No, this is 40%. So take 40% of 1748. Right. That's your variable cost. Okay, now get your contribution margin. Okay. All right, now go get your fixed costs. FC, yeah. Fixed cost 84 and 732. No, yeah, put them right there. FC.
Copy pasted for me to see.
Okay, 384 and 730. Okay, net income. Right, 265.6. Right. Okay, wait a minute now. Go back to your problem. Your problem said how much was the profit going to increase? It went from 240 to what?
128,000. 128 here.
No. Take that 22.8 out, 22.2. Take that out of there. How much will your profit increase? What is it now? 240, right?
Yes.
What is it that you just calculated? 265?
Yes.
600. So take
Yes.
265, 600, and minus 240. No. 264, 600 minus 240, 25,600. Right. Now, wait a minute. Go do the other one. 316 minus, what was it? 240, 76. Put those numbers in. 25.6. Okay. Whoa, what did you do?
It's just that the second.
Okay. Right. So which one was better income?
This one, because it's an increase.
Right. So put computer. Okay. There you go. Did you see? Did you follow that? You could have done the same thing by taking the percentage increase times the degree of operating leverage, but times 128. All right, the next one is the margin of safety. Now, the margin of safety is going to be higher for the manual than the computerized. So the margin of safety is what I'm selling, the original scenario. What I'm selling, go back up, what am I selling? Okay, 1620. All right, so that's the sales I have now. What do I need to break even?
And
For manual.
so that would be the break-even formula, which is
Right.
Fatima, are you with me?
Hey. All right, look, you need two things here. You need the contribution margin ratio. So get the manual system, take the contribution margin as a percentage of sales. What do you get?
This is for requirement C or B? C.
Yeah, margin of safety. You need the contribution margin ratio. So get it.
So sales subtract break-even sales divided by sales.
Right, but we need to figure the break even on sales. So to get the break even on sales, you need the contribution margin ratio. So what's the contribution margin ratio for manual?
It's 20%.
Do you remember how to get the contribution margin ratio?
Yeah.
Contribution divided by sales
Yeah.
multiplied
what is
by
it?
100.
What?
Then to make it percent, and you multiply by
Yeah.
100.
You take 324 divided by 1620. What do you get?
20%, I think.
Percentage.
Okay, is it
For me.
20%?
For my numbers, it's 20%.
Yeah, probably. Put 20% off to the side.
Then for the second one, also for one time, take it.
Okay, what's the contribution margin as a percentage of sales for computerized?
60%.
Okay, so the contribution margin ratio is 20% and the fixed cost is 84. So what's the break even?
The break even.
Manual. You see how everything comes back? What's the
so
break?
Divide by
Right, what do you get in sales?
84,000 divided by point.
By what? 20%?
Yeah.
What do you get?
420,000.
ليش divided by 20%? تعال ليش why? Victor, multiply by 20%, not divided by 20%.
Break even, fixed cost divided by contribution margin ratio.
Oh, okay, sorry.
So what do you get?
Yeah, 420,000 for the manual.
Okay, wait a minute now. Take the sales and subtract
The break even sales
the break even, and what do you get?
divided by the sales.
Right.
62 million minus 420,000.
Yeah, what do you get? Divide that by sales.
1.2 million.
No,
What?
no. How much?
So 1,620,000 minus 420,000.
Yeah.
Divide that by 74.74%. Yeah, 74%.
Okay, go down, put 74% in. Is it right on? Or 2 decimal points? Is it 0.00?
0.07.
Okay. That's the margin of safety. Percentage. Okay, they don't want percentage, but that's,
It
What
will
is break-
0.98, I think.
okay, now go back up. You have to do the break even for computer. How's the break even for computer? What's the contribution margin ratio?
60%.
Yes.
60, okay, divide 60 into 732. What's the break even?
132,000 divided by
24.
0.6.
Yeah,
No, 700.
1 million something.
1 million something's not good enough for us. We gotta do better than that, then.
He's calculating his number, so.
Wait, let me do that again. 732,000 multiplied by 0.6. So,
No.
No.
What's the
Divided by
contribution margin ratio?
sorry.
Right.
Divided by
732 divided by 60%. What do you get?
1,220,000.
Okay, subtract that from 1,620,000. And there's your margin of safety in dollars. Then take that as a percentage of 1,620,000.
That's
And you got
400,000. So 400,000 divided by,
Okay.
it's 24.69.
Okay, there you go. Let's see if your numbers are right. So you see the margin of safety is much greater for the manual system than it is. Nope.
No, it's
You
not.
got-
No, it will take with the points, not with the percentage.
Yeah. I think maybe, yeah, I think you're right. 0.74. Put that first one as 0.7. It's just the way you put it in. I think your numbers are right. Okay.
This?
Yeah, and put this one as 0.45 or 47.
Okay, here there is another.
Okay. Manual.
Manual.
Margins. Yeah. There you go. Now,
That was a challenge.
now you're happy.
It was confused question, Doctor.
I don't
It's
know
a
if this comes for
difficult
exam.
question,
I don't know if
but
this
it
kind of
takes in
question comes for
everything you
exam.
need
It's
to
going to be
do.
pretty difficult.
Okay. Any questions?
Professor, so we have to make the exam easier. So if this kind of exams come, I don't know how we are going to pass.
It's going to be like the last exam, but no, you wouldn't get a question like this. You'll get margin of safety. You will get target net income. You'll get break even. You'll get sales mix. You'll get degree of operating leverage.
But it's Wiley plus, right? So Wiley plus randomizes the
No,
question.
it's not Wiley Plus.
Yeah, for the quizzes, the lockdown browser.
No, the
Right.
face to face.
It'll be multiple choice.
The quiz
Okay.
is day after tomorrow, right?
That's what, yeah, today's Monday, so Wednesday's the day after tomorrow.
Okay.
Doctor, are we having a class on Wednesday?
No, you have your assignment and a quiz. Now, I'll do a review at the beginning of the class if you want, if you have any questions.
Yes, it's okay.
Make sure you do the assignment before so you get some experience in doing this. Okay?
Okay.
Concentrate on doing the assignments, get them done.
Doctor,
Yes?
or assignment 2, I guess. Can't remember. I put my own.
Assignment 2 is
Yeah.
based on costs, so it will help you.
So how can I say it?